Continuing with our session and topic on alternative investments, in this session we will look at the topic of exchange traded funds. First, let's understand what are exchange traded funds. ETFs, as they are popularly known, is an investment fund which is traded on stock exchanges, very much like the stocks or the closed-ended mutual fund shares, which means that they are tradable at the hands of investors in the secondary market. An important feature of exchange traded funds is that they hold a fixed portfolio of financial securities under them, and usually on most occasions they track or mimic an index of the stock or a bond or a commodity or a currency as an investment class. Further, the ETFs trade close to its net asset value of the underlyings during the trading day. Obviously, this is impacted by the demand and supply forces and the liquidity that is there on the ETF. And an important feature, largely that is the most important one that distinguishes it from the other ones, is the redemption part. The cash redemption by the shareholders is discouraged in an ETF. We'll understand more about the redemptions in the later slides. So these four are the main features of an exchange traded funds. One is it's an investment fund very much traded on the stock exchange like the shares or bonds. Second, it holds a fixed portfolio, usually tracking or mimicking an index. Third, it trades close to the NAV. And fourth, there are in-kind redemptions, or the cash redemptions are not encouraged, as we'll see later. The benefits of the ETFs. The single most important benefit of an ETF is that of portfolio diversification. When you have a normal traditional investment portfolio like the stocks and bonds, an investment in ETF will diversify it in the manner that you are exposed to a lot of other possible asset classes. So if you invested in an ETF which tracks a currency or a commodity, then it lends you diversification benefit. Also, an ETF can be sold short or bought on margin, which is on the other hand not possible for an open-ended equity mutual fund. So which means that leverage is possible in an investment in ETF. The third one is there is lower expense ratio than those of an average mutual fund, meaning the costs of running an ETF, which are ultimately borne by the investors in the form of fees and charges, are lesser as an investment in ETF as compared to an average mutual fund investment. This improves the returns to the investors to some extent. And another important point that we also saw on the last slide is the in-kind creation or redemption of the shares, leading to lower tax liability and as a result higher returns for the investors. To explain this further, say in case of an equity mutual fund where an investor wants his or her money back, then they seek redemption. Say if it's an open-ended mutual fund, then they ask for redemptions. In that case, if the fund does not have or has a limited amount of cash liquid with it, then it will have to sell the underlying investments to realize cash for the redemption purposes. Now this sale of securities will lead to an incidence of capital gains if the value of the securities are higher right now than what they were bought at. So there is a capital gains tax at every point of sale of the securities. The difference here is that ETFs allow in-kind creation and redemption of the shares, which means that there is no need to sell the underlying investments, but the investors who want to get redeemed are given in-kind redemption of shares of the underlying ETFs. So further, there is an option of reinvesting dividends also immediately in case of an ETF. If the investor chooses so, not to receive the dividend in cash but to reinvest those units in the ETF, that option is available here, which is a benefit. So disadvantages of ETFs. There are fewer indices to track for ETFs outside the US, so it would result in a biased portfolio of large cap stocks only for the ETFs that are tracking non-US economies. Also, in case of inefficient markets, there would be large bid-ask spreads for ETFs, which could be a result of a low trading volume also, if the markets are not mature to handle this kind of an investment option. And some of the large ticket size investors may prefer to directly invest in an index-based portfolio rather than to invest in an ETF which is tracking an index. In that case, they cut down on the fees and all the risk and returns are directly flowing to them. Now let's look at some of the risk factors of the ETFs. For an ETF, there could be a difference in the current trading price through the day and the underlying NAV values because of the demand supply forces and liquidity of the ETF itself. So you see that the underlying NAV per share of the ETF is say $10, but it could be trading at $10.5 or $9.5 because of the demand and supply or the popularity of that particular ETF. Also, there is an exposure to the market risk or the sector risk or the asset class risk based on which the ETF is performing or the benchmark index that the ETF is tracking. So all the risk factors that affect the benchmark will also ultimately affect the ETF. Further, there could be a tracking error. By tracking error, we mean that an index that is supposed to track that an ETF that is supposed to track an index may deviate from this actual performance because of its percentage holding. Say for example, the index that is being tracked by the ETF has performed like this, and the actual performance of our ETF will be so this difference is called tracking error. Further, the investors are also exposed to the leverage and credit risk in case the ETF is using derivatives for investments as well. Further, if the ETF is tracking an country-based index, then the country risk is also comes into picture, and also the currency risk, where the investments are made in the foreign securities, so there will be an exchange rate risk or the currency risk that is affecting an ETF.